Here's something nobody's really saying out loud. Making $150,000 a year in 2026 might not actually be enough to safely afford a $500,000 house. Let that sink in for a second. 6 figures, $150,000 a year, and you could still end up one bad month away from feeling financially trapped inside a house you technically own. Now, on paper, everything looks fine. Multiple housing projections suggest that with 20% down and mortgage rates around 6%, the safe income to afford a $500K home lands somewhere between $146K and $160K a year. So the bank runs the numbers. You qualify. They approve the loan. Everyone smiles. You sign. But here's the uncomfortable truth most buyers only discover later. Qualifying for a mortgage and comfortably living with that mortgage for 30 years are two completely different games. Because there's a question almost nobody asks at the closing table. What happens 6 months after you get the keys? When the excitement fades, when the real bills start showing up, and when the payment that looked reasonable on paper starts competing with real life. Today we're breaking down the math banks use, the math real life uses, and whether buying a $500,000 house in 2026 is actually building your wealth or quietly draining it. Stick with me, because what I'm about to show you might completely change how you think about the word affordable. Most people operate on one very simple belief. If I can qualify for the mortgage, I can afford the house. And honestly, the logic feels perfectly reasonable. Banks approve loans using something called a debt-to-income ratio, and the traditional guideline has always been simple. Keep your housing costs under 30% of your gross income. So let's run the same numbers most buyers run. Imagine you and your partner earn $155,000 a year combined. You put 20% down on a $500,000 house, that's $100,000 up front. You borrow the remaining $400,000 at roughly 6% interest. Your monthly principal and interest payment lands somewhere around $2,400 to $2,600. At first glance, that seems totally manageable. But this is where the real numbers start showing up, because the mortgage payment is only the beginning. Now add property taxes, add homeowners insurance, add HOA fees if the property has one. And then there's the cost almost every first-time buyer forgets. Maintenance. Roofs wear out. Water heaters fail. Something always breaks. Once you include those pieces, that $2,500 mortgage quickly turns into something closer to $3,200, sometimes even $3,500 a month, every single month, for the next 30 years. Now, technically, the numbers still work. On paper, you're within the rules. But here's where the logic quietly starts to crack. That famous 30% rule? It's based on gross income, the number you earn before taxes, before health insurance, before retirement contributions quietly disappear from your paycheck. In other words, it's not based on the money that actually lands in your bank account. So the real question becomes this: are you budgeting based on what you earn or based on what you actually keep? Because that gap between gross income and real take-home pay is exactly where many homeowners start feeling the pressure. And once you see that difference clearly, the math behind a $500K house starts to look very different. And the next part of this story makes that gap even more obvious. Let's make this real. Meet Alex and Jordan. Early 30s, dual income, combined salary of $155,000 a year. A few years ago, they bought a $500,000 home in a growing mid-sized city. By every traditional metric, they were perfectly fine. Mortgage payment, $2,500, taxes and insurance, $600, HOA and maintenance reserve, $400. Total monthly housing cost, right around $3,500 a month. At first glance, that sounds reasonable, but here's where the picture changes. After taxes and deductions, their actual take-home pay is about $9,000 a month. Now do the real math. That $3,500 housing cost isn't 30% of their income anymore. It's closer to 39% of their actual spendable money. Not 30, nearly 40%. And that's before real life even enters the budget. Add car payments, add student loans, add groceries that cost 20% more than they did just a few years ago. Then layer in the things you're supposed to be doing financially, saving for retirement, building an emergency fund, planning for the unexpected. That comfortable margin they thought they had, it disappeared faster than they expected. And this leads to a contrarian idea worth sitting with for a moment. The 30% housing rule might be outdated. It was designed for a completely different economic environment, a time when healthcare was cheaper, education cost far less, and everyday life was significantly more stable. But in 2026, the financial landscape looks very different. And there's a statistic that should genuinely make people pause. According to the Mortgage Bankers Association, nearly 40% of homebuyers say they regret their purchase. The most common reason? Costs they didn't fully anticipate. 40%. That's not a small minority. That's almost half of buyers. But there's another cost most people never calculate: opportunity cost. If $3,500 a month goes toward housing instead of investments, what does that really mean over time? At an average 8% annual return, investing just $1,000 per month could grow to more than $180,000 in 10 years. That's not theoretical wealth. That's real money you're potentially trading away for extra square footage. And here's the twist most people miss. The numbers alone aren't the biggest risk, because the real reason people stretch their housing budgets often has nothing to do with math. It has everything to do with psychology, and that's where things get even more interesting. Let's be honest, buying a $500K house was never just a financial decision. It's emotional. It's status, it's identity wrapped in drywall, granite countertops, and perfectly staged Instagram shots. You see your friends upgrade, you scroll through social media, and you think, if they can do it, why can't I? That is social proof pressure, one of the most expensive psychological traps in personal finance. Then there's optimism bias, that deeply human tendency to assume your income will always rise, your career is bulletproof, the market will always reward you for buying right now. Here's the part nobody warns you about. The payment doesn't feel heavy on day one. It feels exciting. It feels like a win. But by year 3, the novelty fades. The HVAC unit breaks, lifestyle inflation creeps in, more space, more furniture, higher utility bills. Suddenly, that $3,500 payment quietly starts to double down on your budget. Picture this: 5 years from now, you're sitting in that house. One income drops, a layoff, a health issue, or a career pivot. Childcare hits $2,000 a month. Now ask yourself, does that $3,500 housing payment still feel manageable? Or does it feel like a ceiling you can't breathe under? Alex and Jordan learned this the hard way. Their solution? Side gigs. Not for vacation money, not for investment cash, just to cover the basics without anxiety. That's the trap almost no one talks about. Not foreclosure, not bankruptcy, just relentless, low-grade financial pressure that quietly kills every other goal you have. And here's the question that changes everything. What if you didn't have to fall into that trap? What if you could make a smarter move before buying the house, before signing the contract, before you committed 3 decades of your life to a payment? That's exactly what we're about to explore. Here's the first rule of making smart housing decisions in 2026. Flip the entire question. Stop asking, can I qualify for the mortgage? Start asking, can I survive this payment comfortably on one income? That single filter eliminates most risky purchases immediately. If the answer is no, or even barely, that's your answer. Second, run a real-life budget test, not the bank's version, yours. Take your total monthly housing cost, add 1% of the home's value annually for maintenance and repairs. For a $500K home, that's about $5,000 a year, roughly $417 a month, money most people forget. Now calculate housing as a percentage of your net income, not gross. If that number exceeds 35% of your actual take-home pay, you're entering stress territory. Not necessarily danger territory, but one bad quarter, one unexpected expense, and suddenly, things fall apart. Third, stress test your future self. Ask, what if mortgage rates don't drop like experts keep promising? What if property taxes rise, as they historically do? What if my industry contracts or my job changes? Here's a reality check. Housing in 2026 isn't skyrocketing like it did in 2021. Price growth is flat or near flat in many markets. That means there's no guaranteed appreciation safety net if you overstretch. You can't just flip your way out of a bad buy anymore. And here's a counterintuitive insight that might surprise you. Sometimes the smartest move isn't buying a smaller house. It's waiting 12 to 18 months, intentionally, while stacking liquidity and watching how the market moves. Cash isn't defeat. Cash is optionality. And optionality? That's power. Remember, a house should be a tool that strengthens your financial position. The moment it starts controlling your decisions, what vacations you take, whether you can survive one bad month, whether you can leave a job you hate, it stops being an asset and starts being a sentence. So, can you actually afford a $500K house in 2026? Mathematically, maybe. Sustainably, that depends entirely on how honest you're willing to be with yourself. Here's what we've covered. Income thresholds of 150K plus that look safe on paper but get thin fast in real life. Monthly housing costs quietly creeping toward 40% of take-home pay. Hidden expenses, maintenance, repairs, and opportunity costs that nobody puts in the brochure. Psychological pressure, social proof, optimism bias, status that makes bad decisions feel obvious. This isn't about fear, it's about clarity. Because the most damaging financial mistakes aren't dramatic, they're slow. A payment that feels just slightly tight, a lifestyle that quietly contracts, investments that never happen because there's never quite enough left over. So before you chase that house, ask yourself one question. Is this building wealth or just building a bigger bill? Here's the part most people never realize. Your future self isn't going to remember how the house looked in the listing photos. They won't remember the granite countertops or the perfect backyard. They're going to remember one thing, whether that decision gave them freedom or quietly took it away. Pro tip for next steps: if you want a real financial edge in 2026, check out the next video. Is renting in 2026 actually smarter than buying a $500K home? The math might genuinely surprise you. Choose wisely, because your future self is already living with the choice you make today.